Most people think they get denied for a mortgage because they can't afford the home. That's almost never the real reason. In reality, buyers get denied because of a very few specific mortgage problems that no one explains to them ahead of time. The frustrating part is that most of these are fixable if you know about them early enough. Today, I'm going to walk you through the 7 most common mortgage problems I see that stop buyers from getting approved, and more importantly, what actually fixes them. I've been doing this for over 2 decades, and I can tell you with confidence, 2 buyers can make the same money, have very similar credit scores, and one gets approved while the other gets declined. The difference isn't luck, it's understanding how the mortgage rules really work. Let's start with credit, because this is one that surprises people. Your credit score alone is not the problem. What lenders actually care about is your credit profile. You can have a decent score and still get denied because your credits are maxed out, your balances are too high compared to your limits, or your credit was recently opened the wrong way. 2 people can have a 680 FICO score, one gets approved easily, the other doesn't. The fix here usually isn't time, it's strategy. The next issue I see all the time is income. And I believe this is the number one reason why people get declined. The loan officer doesn't know how to work up the income properly. This one hits a lot of self-employed borrowers and business owners. You make great money, but on paper, it doesn't always show the way that mortgage guidelines require. Write-offs, depreciation, or inconsistent income can dramatically lower what you qualify for. It doesn't mean you're stuck. It usually means you need a different documentation approach or a loan program that actually looks at the cash flow instead of tax returns. The problem isn't income, it's how the income is being measured. Another quiet deal killer is debt to income ratio. This isn't about how much debt you have overall, it's about your monthly obligations. Student loans, car leases, credit cards, all get calculated a very specific way. Even if you pay more, the lender still just counts the minimum payment. I see buyers all the time who technically make enough money, but the math doesn't work because of how those payments are calculated. The fix here is often quite simple, but timing matters. Job changes and employment gaps scare a lot of buyers, but changing jobs doesn't automatically disqualify you. You don't need a 2-year history at the job. What matters is consistency in your line of work and how you're paid and how long that income can be documented. Gaps can often be explained. Commission income can work, bonuses can count. The issue usually isn't the job change itself, it's whether it's structured correctly for underwriting. Typically, commission and bonus in self-employed income requires 2 years, especially on some loan programs, but you can often go with just 1 year in the right circumstances. Down payments are another area where people get tripped up by bad information. Most buyers think the down payment is the biggest hurdle. In most cases, it isn't. There are options with 3%, 3.5%, 5%, and even 0 down in some cases. What actually matters is how the funds are sourced and whether you have reserves in some cases. Having the money is one thing, showing it where it came from is another. Bank account activities cause more last minute stress than almost anything else. Large deposits, cash, Venmo or Zelle transfers, or even crypto aren't automatically bad, but they do need to be documented correctly. The biggest mistake I see is people moving money around after they applied without asking first. That's when the red flags pop up and deals get delayed or worse. Typically, we're looking at 2 months of bank statements, and any large deposits have to be sourced and seasoned. The most expensive problem of all is getting bad advice. Online pre-approvals, quick pre-quals, or someone saying you should be fine are not approvals. Real approvals come from reviewing income properly, looking at the credit strategically, and reviewing the assets to make sure that it all works. Identifying issues before you're under contract. Most mortgage denials don't happen at the application. They happen in the middle of the transaction when it's too late to pivot. Here's the bottom line. Most mortgages don't need miracles. They need a clear path and right timing. When buyers understand where the landmines are, the process becomes calm and predictable instead of stressful and reactive. If you like this video and you don't think it's unreasonable to figure out where you stand before you make an offer, if you want help building a clean, no pressure game plan, you can call or book directly with me. Or if you know someone that's confused or struggling with their loan in the home buying process, feel free to pass this along. Like, comment, subscribe, and follow.